Welcome back, industrial investors. Today, we're diving deep into the industrial sector, analyzing four of the biggest players in this space: Caterpillar Inc., Deere Company, FedEx Corporation, and United Parcel Service. These giants play crucial roles in global infrastructure, logistics, and machinery, but are they good investments right now? Let's break them down metric by metric to uncover the story behind the numbers. The price-to-earnings ratio helps us understand how much investors are willing to pay for each dollar of earnings. A lower P/E ratio typically indicates a company is undervalued or has lower growth expectations, while a higher P suggests a premium valuation due to growth potential. Caterpillar currently trades at a P/E of 16.02, slightly lower than its 5-year average of 18.89. This suggests it may be undervalued relative to its historical range. The forward P/E of 15.42 hints at moderate future growth. Deere trades at a P/E of 21.28, above its 5-year average of 18.71, indicating a premium valuation, suggesting strong growth expectations. Its forward P/E of 21.55 reinforces steady earnings expectations. FedEx has a P/E of 15.82, slightly above its 5-year average of 14.86, meaning it is fairly valued. The forward P/E of 11.97 suggests analysts expect earnings to rise significantly. UPS trades at a P/E of 15.03, below its 5-year average of 16.86, signaling potential undervaluation and a possible investment opportunity. When we factor in growth relative to valuation using the price-to-earnings growth ratio, a lower price-to-earnings growth ratio typically suggests the stock is fairly valued relative to its growth rate, while a higher price-to-earnings growth ratio indicates a stock may be overvalued. Caterpillar's price-to-earnings growth ratio of 4.12 means it trades at a premium relative to its growth, potentially making it overvalued. Deere's price-to-earnings growth ratio of 2.76 also indicates a relatively high valuation, though with strong growth potential. FedEx has a price-to-earnings growth ratio of 1.32, suggesting it is more fairly valued, offering a reasonable balance of price and growth. UPS stands at 1.93, making it moderately priced compared to its growth. Insider ownership can indicate how much confidence executives have in their own company. A higher percentage suggests strong belief in long-term success. Caterpillar's insider ownership is just 0.19%, which is very low but common for large corporations where institutional ownership dominates. Deere has a significantly higher insider ownership at 7.43%, showing solid alignment between management and shareholders. FedEx leads with 8.54%, a strong sign of confidence from leadership, while UPS stands out with a very high insider ownership of 14.38%, showing strong belief in its long-term potential. Profitability is key when analyzing companies. Looking at return on equity, return on assets, and return on invested capital, we measure how effectively a company is using its capital to generate profits. Higher values indicate more efficient operations. Caterpillar shows impressive profitability with a return on equity of 55.36%, return on assets of 12.32%, and return on invested capital of 22.57%, suggesting it is very effective in generating returns for shareholders. Deere has a return on equity of 27.91%, return on assets of 6.08%, and return on invested capital of 11.32%, demonstrating strong efficiency but lower than Caterpillar. FedEx, while solid, lags behind with a return on equity of 14.59%, return on assets of 4.47%, and return on invested capital of 10.16%, showing it is less efficient in generating returns. UPS delivers strong performance with a return on equity of 33.99%, return on assets of 8.21%, and return on invested capital of 18.43%, making it a solid contender in profitability. United Parcel Service has maintained relatively flat shares outstanding, meaning no dilution over time. While the other three companies have a clear buyback program over the last decade, with almost 2% shares outstanding reduction each year reinforcing its shareholder-friendly approach. Earnings growth and free cash flow are also critical indicators of financial health. Companies with consistent growth in these areas tend to have sustainable business models. Caterpillar's earnings per share or EPS is currently at $22.05, with an expected growth of 3.89% compound annual growth rate over the next 5 years, indicating moderate but stable growth. Deere boasts an EPS of $22.57, growing at 7.72% compound annual growth rate. So despite being in the same industry, it is a different business. FedEx's EPS stands at $16.93, projected to grow 11.95%, while the competitor UPS is projected to grow at a slower pace of 7.8%. Additionally, looking at the free cash flow per share evolution, Caterpillar has grown at 12.2% compound annual growth over the last decade, reinforcing its strong cash generation. Deere with an free cash flow per share growth of 18.69%, showing a strong growth trend. UPS free cash flow per share has only increased at 2.64% in the last decade, indicating slower growth of four companies. For dividend investors, yields and growth rates provide insights into income potential. A higher dividend yield is attractive for income-seeking investors, while strong dividend growth suggests a company's ability to increase payouts over time. Caterpillar has a 1.6% yield, growing at 7.29%, which is solid but not the highest and has a very low payout ratio. Deere's yield is slightly lower at 1.35% but has grown at 9.83%, indicating strong dividend expansion. FedEx offers a 2.27% yield, growing rapidly at 20.25% with some years of impressive growth and others with almost no growth, making it an attractive option for dividend growth investors. Finally, UPS stands out with a 5.64% yield, offering the highest immediate income but growing at 8.48%. So if the dividend growth more quickly than the free cash flow, we have what we can see. A free cash flow payout ratio very close to 100% and a growth below 1% for the next years until the situation normalizes the unnecessary dividend increase of almost 50% in 2022. Margins reflect profitability and efficiency, with higher values indicating better cost control. Caterpillar has an operating margin of 20.67% and a profit margin of 16.65%, making it a strong performer. Deere has an operating margin of 23.27% and a profit margin of 12.94%, also showcasing efficiency but slightly lower profitability. FedEx operates with thinner margins at 6.79% operating and 4.44% profit, due to high logistics costs. UPS has an operating margin of 9.53% and a profit margin of 6.36%, indicating moderate efficiency. All four companies show positive revenue and earnings evolution, reflected in their market performance relative to the XLI Industrial ETF, except UPS, who lagged far behind them. Debt is a crucial factor in financial stability, with lower ratios indicating lower financial risk. Caterpillar has a debt/EBITDA ratio of 2.36 and a debt/FCF ratio of 4.29, which is moderate and manageable. Deere, however, carries much higher leverage with a debt/EBITDA of 4.46 and debt/FCF of 15.48, meaning it is more reliant on debt. FedEx also has high leverage, with a debt/EBITDA of 3.60 and debt/FCF of 14.25, making it riskier. UPS, in contrast, maintains solid financial stability with a debt/EBITDA of 2.27 and a debt/FCF of 4.30, meaning it is in a stronger financial position. Stock performance over the past year provides further insights into market sentiment. Caterpillar has gained 11.56% in the last 52 weeks, showing steady growth. Deere has surged 24.8%, reflecting strong market optimism. FedEx has risen 13.06%, whereas UPS has underperformed, declining by 19.41%, suggesting investor concerns. Now, let's talk about the crystal ball moment: analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. Caterpillar has a price target of $390.82, representing an upside of 10.61% from its current price of $353.32. My fair value estimates tell a very different story. For me, Caterpillar is close to its fair value at $312.95. That suggests it is overvalued right now. Remember that this type of business is very cyclical and is a must to invest when the cycle is on its low. Continuing with Deere's price target is $480.88, which actually represents an upside of 0.14% from its current price of $480.22, indicating that analysts see the stock as potentially fair valued. And for me, Deere, with a fair value of $403.32, appears currently overvalued too. Now, FedEx has a price target of $320.69, with an upside of 19.76% from the current $267.77. And for me, with a fair value of $288.58, can indicate an undervaluation of this company, and also a good entry point. Finally, UPS's price target is $132.56, representing an upside of 14.06% from its current $116.22, with a fair value for me of $123.42, which is far from the current price and can indicate an excellent opportunity to start a position. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. Each of these companies offers something unique to investors. Caterpillar stands out with strong profitability and a reliable dividend. Deere provides high growth and excellent margins but comes at a premium valuation. FedEx offers robust dividend growth and potential upside, while UPS boasts a high dividend yield but has struggled in stock performance recently. Which one fits your portfolio? Let me know in the comments. If you enjoyed this deep dive, don't forget to like, subscribe, and hit the notification bell for more financial insights. Until next time, happy investing!